Okay, so 1, 2, 3. I think we're gonna be live on YouTube. Oh, let me just get the headsets on. Okay, I think we are now live on YouTube, and we are also live on Zoom. All right. Okay, so guys, welcome, welcome. If you just joined us, let us know where you guys are watching from. As you know, every Thursday we have a very interactive webinars with our guests. Today I'm with Sam, and we're going to be talking about diversification in both currency and country. Look, if you guys are just joining us today, just let us know in the chat box where you guys are watching from, and we always try to make it for a very, very good interactive webinar. So I'm gonna be also letting you guys ask Sam a lot of questions as much as you can. If you have any questions that are pending questions, leave them in the Q&A box. And then also, if you can't hear me or you can't hear Sam, let us know in the chat box as well if you can hear any of us. So as we're waiting for other people who are joining us on African time, we're going to give them the next 2 to 3 minutes for us to join this, for them to join us actually. So let us know where you guys are watching from in the meantime, and so I can welcome you as well. And also let me know if it's your first time joining us as well. So just let me know in the comment section, and let me welcome you like we always do. We try to make it a very, very interactive webinar as we always do. And this is because of it always makes for very, very good dialogue, especially, now because of the lockdowns and things like that. At least you're on level 2 right now, so we can move around a little bit. But since we couldn't move around a little bit, it was a little bit of an issue for everybody, just to be very mechanical and technical online and both offline. So that's a little bit of a problem there. So for those who missed the previous sessions that we had, I want you to go and check out our YouTube channel as well. And there's a lot of sessions there. You guys must follow us there and also get all the sessions from the YouTube channel as well. So if you just joined us, okay, I see Alfred from Lipalale. Alfred, welcome. And it's good to have you here. And I hope you're going to have some fun. Actually, you are going to have some fun in this webinar. So we're going to try to make sure that we have like a very, very value-adding and interactive webinar as much as possible. Otherwise, if you just join us, let us know where you guys are watching from the comment section. And so I can welcome you as well, and let me know if it's your first time joining us. Because today we actually started a little bit late than usual. We usually start at 12 p.m. So today we started a little bit later, but we're giving the guys with African time because we sent you guys some reminders to join us in the next 2 minutes, and they're going to be starting. Okay, so I see Goodness from Pretoria. Hi, Goodness, welcome. It's good to have you. We have Pretoria in the house. Then we see Vincent from Johannesburg. Vincent as well. Okay, 100%. Welcome, guys. And look, we're going to try to add some value, as much value as we can in this webinar. And welcome. And you guys are going to have, you are in for a treat. You're going to have some fun. Otherwise, let me know what you guys are excited to hear about today. Let me know what you guys are here excited to learn about. Your main thing, just one thing that you guys are excited to learn about before you get started. And I'm going to be obviously going into the details with Sam. And I'm also going to be opening up for the Q&A session for you guys to ask as many questions as you can. As you guys always know, we make these sessions for you guys to ask many questions, get educated, and also be able to make, some very, very informed investment decisions. I see Zokolo Jack from PE. Okay, we also have PE in the house. Welcome, guys. Welcome, Port Elizabeth. That's pretty cool. That's pretty cool. So you see, we always have like diverse audience from Limpopo, Lepalale, Pretoria, Johannesburg, and PE as well. So let us know where you guys are watching from. I see we don't have a lot of Cape Townians in the house. Do we have anybody from Cape Town as well today? So let us know in the chat box where you guys are watching from. I like this because it always makes for very good and diverse audience, and also a good and interactive webinar as we always do. So we are starting right now actually, and I wanted to say a few house rules before we start. First of all, we use the Q&A box, right, for questions and answers. So if you guys have any questions that you want to ask during the presentation, and as well as after we are done when we're opening up our Q&A, you must put it in the Q&A box, because it's going to be able to help us to go through all the questions as much as we can, and then be able to answer them by the end of the session today, because that's what we're here to do. So that's number one. And then the second one is I have to send you guys an ebook if you haven't gotten our ebook as well. Look, you have to get this ebook. I think we have thousands of people in our community who are having this ebook, and we're having some very, very good reviews. You guys must go and check out the ebook. And I'm sure the guys who already have the ebook, they'll let you guys know about it as well. So it's in the chat box. Go and have a look at that as well. And also join us for online training as well. I think some of you guys already are on our online training, but if you haven't, I think you're missing out a lot, and I don't want you to do that for yourself. Go on the page and see what other people are saying about these stuff that we're giving you, and see all the recommendations, and also the people of what are benefiting from joining us, who are part of our community as well. So we're going to be starting now, and today I'm with Sam. Sam is actually a member of a team at Brightsky Capital. So Brightsky Capital are a capital or private equity fund investing in the UK build to rent market, with particular focus in London and southeast of England. He will tell us why they're only investing or focusing on southeast of England as well, because I'd like to hear about that too. Sam has UK legal background and a significant track record transactioning in the UK, Europe, Africa, and the Far East, and a focus on Africa and the UK. Samuel, welcome today, man. It's good to have you here.
Yeah, thanks very much for having me. And also thanks everyone else for accommodating my diary and moving it to 1 p.m. Instead of the usual 12 o'clock. I'm sorry if that was inconvenient.
100%. So let's talk about a little bit about you, Sam. For those who don't know you, can you tell us who is Samuel, and how do you like to describe what is it that you do?
So obviously, yeah, I'm Sam. I was originally born in South Africa, and then my parents immigrated when I was younger, which is why I guess I've got a bit of a weird hybrid accent. So I grew up in the UK. I was predominantly educated there. Went to university there and basically qualified to be an attorney, but specializing in commercial and real estate law. So, I mean, I come from a family where everyone's been quite heavily involved in real estate. So it's kind of in my blood. I'm quite passionate about it. And I think one of the nice things as well about real estate in general, with a few exceptions, I guess, is that, you know, compared to a lot of other areas of business and a lot of other areas of investment, it's fairly easy to understand. You know, it's a nice product because it's tangible, and you know, I think people feel a lot of security with that. So you know, it's when something's tangible and physical, it's quite easy to get your head around it compared to, you know, other stuff like commodities, perhaps forex. Yeah. So, you know, obviously when I decided that I didn't really want to be an attorney, I moved back to South Africa to study some more. And I ended up working in corporate advisory for one of the big corporate advisory companies here. I'm not sure whether I can actually mention their name for legal reasons. So, you know, it's best that I don't. But I got a lot of experience working with multinational clients, you know, both in South Africa and across Africa. And a lot of those clients are actually kind of UK orientated. So, you know, kind of through my career and roundabouts and kind of around the way, I've managed to get a lot of experience across Africa and in the UK and Europe, among some other stuff in the Far East and so on with some other clients. But I think what's quite nice about it is that I have, as does the rest of our team, for various different reasons as a consequence of kind of their past and track record and career history. You know, we have a lot of understanding of the South African market, and not necessarily just the real estate itself, but what it is that South Africans are looking for, you know, in terms of their futures, their investments, as well as quite a comprehensive understanding and track record of stuff in the UK. So, you know, we decided to start Brightsky Capital to be a vehicle run by South Africans and Brits collaboratively, you know, to help bring predominantly South African money into diversifying into UK real estate assets, in a way that, South Africans aren't going to get burned because there's an understanding of the UK market. We're well connected on that side. And so that's what we launched about 18 months ago. And that's partly what I'm here to discuss today.
100%. So before we even go further into the questions I might have for you, I wanted to ask a little bit about Brightsky Capital. So what is it exactly that happens with you guys? What do you guys do exactly? And this is because I think we spoke a little bit earlier on that, we have people who are hands-on investors, they want to be hands-on and do the investing themselves. And then we also have private investors who want to be putting money in a vehicle and then they be benefiting from getting the return on a monthly basis. But in simpler terms, what do you guys do at Brightsky? And yeah, exactly. That's something that's we're very, very curious about.
I mean, I guess I'll start with what we do and the structure and how it works. So essentially what we do is, and I mentioned before with some of our connectivity in the UK market, one of our team members used to be head of corporate capital markets for Europe, Middle East, and Africa for CBRE. So through his career and work and his connectivity in the UK market, we get a lot of really interesting off-market deals. So we get them offered directly in a kind of closed bidder context, or we get offered off-market deals before other people have foresight on them. So we have an opportunity to bid on stuff and work at stuff and look at stuff before it really gets taken to the open market. And that falls within what our overall kind of mantra is, I guess, for want of a better word, which is to basically acquire things where we can establish some significant value add, whether it be in one way or various ways. So acquiring things off market often means that we can negotiate a better deal for the various reasons as to why someone's taking it to the market or off market, so not really taking it to the market itself. There's a lot of value to be extracted from that side. So what we do is we take those individual investment opportunities and we package them up in an individual SPV. So each project is its own business and it's siloed from all the other projects. So the reason and the rationale as to why we do that is because our investors get to pick and choose which specific investments they like, which ones they believe in, and their risk is limited to specifically that investment where again, I can't mention names, but I don't want to get a knock on the door from an attorney from some other fund somewhere. But with lots of REITs and different funds, you don't necessarily get the same level of choice and selection into what exactly it is that you're investing into. So what it is that you like, which brought you towards that fund, and what you that specific project that you thought, wow, or, I think this has got great potential. That potential with some other structures that other people offer can end up being diluted by, non-performing assets or poorly performing assets in the rest of their portfolio. So overall, that's the kind of direction we've been looking at in terms of trying to offer what we think the market wants. Because I think, especially when you're investing overseas, most people aren't experts in it, and it can be quite daunting and a bit nerve-wracking to kind of send your money out somewhere into almost the unknown. Whereas, at least with the South African market, people tend to have a bit more of a grasp on things day to day. So it's trying to provide a product to people that, makes them feel comfortable, but as you referred to earlier on, it's tailored a bit more to people who want to be a bit less hands-on. So, you had a guy the other day, and they have a fantastic product, which I think is, mentoring people, on acquiring property in the UK on an individual asset basis, and then sometimes redeveloping them to rent out or to flip. And I think, you know, effectively what that is kind of what we're doing, but on a much smaller scale. But that's much more for people, you know, who want that more hands-on, more direct control. But for us, we're kind of looking to people, I think, that, you know, want what they want, that offshore diversification, and that diversification into another market, but in a much less hands-on way, where they can effectively put their equity in and then see the returns, and benefiting as well from the economies of scale of gearing, obviously. You know, and I think, you know, again, I don't want to have another lawyer knocking on my door, but as I say, but still having that more selectivity of which asset exactly it is that they're investing in, rather than just you know, an acquisition of shares in a wider fund overall.
Definitely understand. And I mean, with listed funds, you have a lot of intermediate, like people in between. Like, so with you guys, you're working directly with a developer, or you're working directly with a capital. So it's like a very few people who are involved in between until you get paid. And that's why, you know, some of the returns that you get from the listed funds, which is not a bad thing, but, you know, you might have a little bit more returns because there's so many people who have to get some fees. And then with you guys, a little bit much more different, because it's like directly with the developer or directly with the fund, which is something very interesting. So let's talk about a little bit about the type of deals somebody must expect when they like sort of talking to you guys that you're picking up in the UK, actually. What sort of deals are you guys looking at? Are you guys looking at flats, blocks, shopping malls, or are you more focused on residential? Or what is it exactly that, you know, your focus is at this point?
So that ties in also with reference to the kind of geographical focus that you briefly mentioned before, with regards to London and the southeast of England. So I guess a good way to summarize overall as an entry into this discussion is that in that area of the UK is where predominantly most of the highest rental values are achieved, and some of the highest property prices. And the reason being is pretty simple, in that the supply just does not meet the demand. You know, there's a huge shortage of houses in the UK. Although it's not equally spread, that shortage, over all areas, but one particular area where that shortage is very apparent is London and the southeast of England. So when I say the southeast of England, it's effectively, if anyone geographically knows London quite well, there's a highway that's orbital to London called the M25, and there's effectively what they call the home counties, which run inside and just outside of the M25. That's effectively the London commuter belt. So, you know, professionals will get the equivalent of the Gautrain into central London and then back out every single day. But yeah, that market suffers from a real severe shortage of residential product. And so, you know, it's the build to rent sector there specifically is something that's a real growth market. You know, I think what we're seeing, which I guess to some extent COVID has catalyzed quite significantly, is this whole idea about the way of working, and you know, how going to the office you know, might change to how it was previously. And so, to some extent, in some areas of London, the southeast, certain types of office space are a bit obsolete now in terms of their ease for commuting, their age, whether the node itself is particularly high in demand for office operations. And as a consequence, you know, the residual value of office space in some of those areas is quite low. And they're a fantastic opportunity to convert into residential, you know, whether to dispose of as individual assets upon practical completion of the development, or in some cases when the scale is right, to rent out and just have as a fully rentalized asset for a period of 7 to 10 years. So in that regard, it's quite similar to developments that you're seeing obviously in Johannesburg CBD. You know, where old office space that doesn't really have a demand for it anymore is being converted into residential and being rented out, albeit the type of rentalized assets that we're looking at is a bit more of a higher LSM. I mean, I guess to support the focus on build to rent, it's also important to look at trends in the UK market and the way that uses of various different types of real estate assets are going. So obviously I've touched upon office space there. I mean, being completely honest with you, office is incredibly strong still in the UK, especially in specific areas of central London. But that type of thing is very much covenant driven. And I think now when you're looking at the fact that there might be negative inflation or deflation, the problem with those assets are all the really good ones, you're going to be competing with pension funds and so on in those acquisitions. So, you know, you're not going to see the type of yields that South African investors want to see, because pension funds are just looking for effectively strong covenants and annuity income over a long period of time. So, you know, they're willing to take, you know, a 2% return, 2% yield in some cases, which obviously isn't good enough for the type of things that we're looking at. But as I've discussed briefly, you know, some of the other office space which provides better returns is more in that market because it's higher risk. And minimizing risk is obviously something we want to do. With regards to retail on that side, it's been happening for a long time. When I was still in the UK, even studying at university, they'd really made a huge shift to things like online shopping and online sales. And they're a lot further ahead of us here in South Africa with regards to that. So even before that, you know, their high streets and a lot of their retail and their malls were dying. And so as a consequence, you know, retail's a bit too high risk. And then on the other end of the scale, because obviously they're so much further ahead of the curve with regards to online shopping and kind of e-commerce, and obviously then all that stuff as it is locally here in South Africa being catalyzed by COVID. The industrial sector is incredibly strong, but again, the problem is with that market currently is it's so strong, it's a bit too hot now. So, you know, acquiring those types of assets, you're acquiring them, you know, at what seems to be almost like the peak of the market, which, you know, is good. Again, I think if you are that type of fund or a pension fund looking, you know, for 15, 20 years of strong covenant from an Amazon or something, but that's long-term income that you're looking for, and you pay that price in the yield. You know, so that leaves us again back through a process of elimination at residential. And, you know, the shortage of residential property in that area is so significant that, you know, it's going to be so many years until it catches up, you know, the supply with the demand. So, you know, even on a 7 to 10 year period, I think, you know, it's a very secure investment opportunity. And I think, you know, regardless of what happens, people always need somewhere to live.
I definitely understand. I think it's the same thing here in SA. However, my question for you right now, since you mentioned online shopping, well, there is an increase in online shopping. I'm not sure about the storage, though, in terms of the storage for the online stores, and if they need a little bit more storage at this point, or there's a little bit more demand there, because there's like a little bit of a cheaper storage that we see here, and then there's a little bit more sophisticated storage, but most of it is like affordable storage houses that we see in North Riding and everywhere around Johannesburg. My question is, what, according to your opinion, actually, or your view, where are you seeing the SA online shopping having like a bigger effect on retail, or do you think people are still going to be going to malls? And what's going on actually in the UK at this point? Because COVID just, you know, accelerated everything a little bit at this point, and everybody's doing everything online. So what are you seeing in terms of that in relation to office spaces and retail in comparison to SA?
I mean, I think, you've got me a bit because it's quite a complex question. I guess there's so many moving parts.
Okay.
I think the problem with I guess they're two different comparisons. They're quite difficult to compare in a lot of ways, but good to compare in some ways because there's a lot of differences. So I think, South Africa, our economy here has been struggling for quite a while, regardless of COVID. It doesn't mean that there's no opportunities here, obviously, and it doesn't mean that there's no demand for all sorts of various types of real estate asset classes. But even despite Brexit and so on, before COVID, the UK market was still growing, and I think it was growing at a slightly faster rate than any of the other European Union economies. The last time I checked, pre-COVID. So I think there is still much more demand for P grade, A grade office space, especially in significant nodes or parts of London, like the West End, Canary Wharf, and the City of London. Whereas comparatively here, I think, we've seen a lot of office consolidations. And so as a consequence, in nodes like Sandton, compared to London, there are huge office vacancies. So in that way, I think it's quite difficult to compare the two, because again, I think to some extent in central London, there's a bit more, especially in the West End of London, there's also a lack of supply for the demand of offices. So I guess apart from in Cape Town CBD, I think the majority of South Africa and most of the main economic nodes, there's an oversupply currently, which is affecting rentals, whereas in some of the significant nodes in the UK, like central London, it's the opposite, despite the fact that there's still economic troubles. But yeah, I mean, going onto the point of retail, I think in South Africa, we're quite a credit-driven economy. So when we see fluctuations in the economy and what's going on, there seems to be a bit more of a direct link as to how that affects retail. Similarly, if the currency depreciates or a politician says something that economists don't like, and it has some sort of negative economic impact, then we tend to see a bit more of a direct and a bit more of an immediate effect on how that affects consumer spending. Whereas in the UK, it's a bit harder to read with regards to that side of the effects on retail. But I mean, as I said before, I think they have a lot more infrastructure in general. They have a lot more kind of courier services and service providers, and their kind of internet and tech side of things has been a bit more advanced for a longer period of time. So I think with the cost of commuting there and the cost of living and the cost of renting and how much time it takes people to commute in general, I think their kind of culture and their living culture has meant that people, to save time at every single corner, are willing to do stuff online. So, I mean, when I was growing up in the UK, going to, major destination malls, the equivalent of Sandton City or Waterfall City, they used to be rammed every single weekend, full of shoppers. And then slowly, even though economically things were going quite well, you started to see them empty out a bit. And it's not because of consumer confidence as such. It's just the fact that people would rather sit on their sofa and kind of do their shopping instead. Whereas I think, here, I think it's great and it's advancing. And obviously, online shopping is moving forwards kind of leaps and bounds. But I do still think that, the ease of doing it is not quite there. I think most South Africans, kind of prefer to go to an actual physical place and do the physical shopping and make sure they actually receive it rather than it being lost in the post somewhere.
I agree. I'm one of those people. However, we just, obviously at this point, I think since 2008 up to now, there's been a little bit of an adjustment because back then, consumer confidence on online shopping was a little bit lower. So right now it's increasing a bit, but at the same time, we still want to do the two. We still want to be able to go to the shop and see that nothing gets lost. But at the same time, you still want to be able to do some of the transactions online. So it was just one of those things I was just thinking in terms of the vacancies we have right now, in terms of the office space and also some retail outlets as well, or a lot of commercial spaces actually that are here, and the newly built ones as well. I was just thinking, maybe it might be because of that, or is it just because of our economy is having like a tough time like it was since 2013? Okay, so I see one of the things that you do is you guys are focusing on residential property. I wanted to ask why residential property compared to other property classes, actually?
So yeah, I think it ties back into what we were discussing before. I think, I think what is actually a bit of a problem, and again, I don't want a lawyer knocking on my door with some sort of suit against me for saying it, but I think a lot of the problem with
Hello? Okay, I think you...
without necessarily a full understanding of how the market.
Okay, Sam, I think we're having a connection problem there. Can you just start over? Yeah, you're back.
Yeah, sorry. So yeah, I think it ties into everything that I said before with regards to the performance of the various asset classes there, why the performances are as they are, and who is competing for what assets as a consequence of their performance. So what you'll find is, you'll find that retail is not doing particularly well, I think, because of the economy in general. I think, Brexit did hit consumer confidence a bit, which did have an effect. And obviously COVID now, with lockdowns and so on, it's not been good for any economy really, especially with regards to retail where, you have to physically go out and be amongst other people, to do it. When it comes to commercial property, especially logistics, which is obviously, a really hot market on the UK side now, and, kind of bigger, more landmark office buildings. The problem there is because the covenant strength of the types of tenants that you have is so strong, and especially on a longer term basis, you're competing again with the big pension funds there like M&G, L&G, and so on. And as I briefly mentioned before, their modus operandi is very different to the type of thing that we're trying to do. We're trying to get high returns over a shorter term, medium term period, for our investors, as a decent competitive investment alternative to other investment products that are on the market, not necessarily just real estate. With pension funds and those types of entities, they're not looking to shoot the lights out in terms of really high yields and returns. They're just looking for certainty, stability, long-term income. So, those, offices and logistics are great investment opportunities in the UK at the moment, but you're just not going to get the types of returns that you'd be looking for realistically on an individual basis. If your pension fund is investing in them, then that's fantastic. It's secure, it's stable, and you're going to have something to retire on. But you get the covenant that you pay for. So with regards to residential, it's everyone always still needs somewhere to live. People always still need somewhere to stay. And again, in that specific region of the UK, and it's also the case with some of the other regional cities like Birmingham and Manchester, there's a huge lack of supply of residential, which means that prices have gone up through the roof. And as a consequence, actually, people can't really necessarily afford to buy, and so people have to rent. Which again has pushed rents up. And I think, that provides a great opportunity because in general, it's not necessarily the type of asset class within real estate itself that some of those bigger players are looking at, because again, in uncertain times, they're looking for the stability of a big corporate covenant. versus speculating on real estate. But if you get the scale right of a residential development, like, for example, acquiring or redeveloping a full apartment building, you benefit hugely from the gearing. So for example, if you're putting 40% equity in and 60% debt, it's, when you look at the asset overall as a residential asset, the yields might not look so fantastic, but when you gear it, you benefit significantly on the gearing. So, I mean, just to give one example, we're just currently, I mean, I can't specify exactly where it is because the transaction is still going through, but we are just transacting at the moment on an old office building in the southwest area of London, and the corporate tenants are gone. There's no residual value in that office building because it's not really a hot office node anymore, but it's becoming very popular in terms of commuting into central London. So, converting that into a residential opportunity, geared, we're looking at annualized returns over a 10-year period of about 18.5%, which is incredibly impressive. And I just don't see where those kinds of returns are possible on offices or logistics when you're competing, as I said before, with people who are looking to pay a lot more than you probably would be able to achieve those yields, because they're looking essentially for just certainty. And again, going back to retail, I think people are trying to mitigate their risk a lot with regards to retail, which is actually something that ties into where we're getting a lot of these really great off-market opportunities from. It's because what you'll find, especially in the UK market, is that a lot of landlords and funds and developers, they're able to gear a lot more highly than most kind of equivalent entities are in South Africa. So some of them on their portfolios will have, kind of an average loan to value of about 90%. They'll gear to 90%, and that's usually fine. But then the problem is, especially because of COVID now, if a retail mall that they own is suffering really badly, the problem is no one's going to acquire an asset from them. They can't sell an asset like that. No one's going to buy something that's struggling terribly. So they're trying to sell off really, really good, strong assets with good covenants, or with great revenue streams. And they're trying to sell those off in the short term to basically cash flow their suffering assets, to kind of get them through the storm and out the other side so they can see what they're doing there. So yeah, in summary, I think retail is just a no.
I definitely understand. And also, if I wanted to ask a question that I also think my audience would benefit from it as well, is why is diversifying important to investors? Not just from the code of not putting all the eggs in one basket, but what is some of the things that you guys get from investors that are investing with you guys, or some of the reasons that some investors that are approaching you guys are looking to achieve when they're trying to diversify their portfolios?
I mean, I think there's a lot of benefits to it, but I guess it depends what your ultimate goal is. I mean, if as we've said before, if you're looking to emigrate, I think in the next few years, I think it's quite a good idea, to be able to offshore your money over several years through various investments and kind of get it all on that side. But I think, and this is much more why, or the type of investor that we were targeting, this is a lot more applicable to the type of South African investor that we've been targeting, is that if you actually don't want to leave South Africa and you want to stay here, you do need some sort of diversification, and just to, I guess, as you're saying before, putting all your eggs in one basket. There are fantastic investment opportunities within South Africa, but I think one of the things is the currency fluctuation. That's something that concerns some people. So you could be getting fantastic returns on some of your investments, whether they're a real estate or not, something else domestically. But if the overall currency is depreciating steadily over a prolonged period of time, it begins to strip out some of the returns on your investments. And that's not I mean that in kind of more of a real terms basis. And that's not me saying that you shouldn't be investing in South Africa. As I said, I think there's so many fantastic investment opportunities here.
Yeah.
And I think especially in real estate, coming out the other side of COVID, I think we're really going to see some fantastic opportunities of being able to pick up some stuff, at some great kind of prices and deals. But I think the biggest bonus to diversifying for South Africans is that stability. And that's again why we chose to invest specifically in the UK. I know obviously the UK has its challenges at the moment with regards to Brexit, and it also has its challenges with regards to COVID-19. But it's still, despite that, the currency fluctuations compared to the South African rand are a lot more stable. I think the problem is British people are they're so climatized to incredible stability that any tiny minute issue that they might have economically within their country, they blow it out of proportion as being the end of the world. Whereas, it's like sunny skies for lots of South Africans in comparison. So I think, I think the nice thing is because, as I was mentioning before, I think because some investors have been a bit burned by the fact that they've just overgeared on their British portfolios, and some investors were a bit uncertain with regards to Brexit. It's meant that we're being offered some fantastic opportunities off market to acquire stuff at a significant discount. So the project that I said we're transacting on at the moment, we've got that at a 15% discount from when it first came to market. Okay. So, this diversification, it gives you that stability, and it gives you that exposure to something that's more stable. But it's not necessarily a stability that you're paying for in a lack of return. I think the great opportunity at the moment is that you can acquire that stability at a discount because of Brexit and COVID. So it's kind of like a perfect storm almost, that Brexit and COVID kind of came together at the same time. And I think, it's just that comfort and peace of mind that people get from having that diversification as well. If something happens with the rand, that you've got money in another currency that hopefully isn't fluctuating so much. And even to the other extent, if you have money in the UK and something bad happens with regards to Brexit, you're still getting those decent returns on the UK side. But actually, if the pound depreciates quite a bit, it might be quite a good opportunity for you to repatriate that money because, again, you're getting a great Forex play. So I think currency is the predominant reason why we see investors coming to us. It's more of that kind of peace of mind of just having money, in another currency. And we see it as well, a lot of them as well, they're also looking at buying, especially some people who have a kind of significantly deeper pockets. They're also acquiring some property in euros. So, it's not necessarily specifically one currency that they're looking at. It's just, again, just to have money in various different times.
Okay, I definitely understand. So I wanted to ask two more questions, and then we're opening up for the Q&A. I think we have like 15 minutes now for everybody to be asking their questions. So how do people get involved with you guys if they want to? I went to your website. I was looking for some deals there. I thought I'll see like a pack or something with like a nice deals, but unfortunately I didn't find anything as yet. So I wanted to figure out, where do people get in touch with you guys if they're looking to see the projects that you guys are working on? And also they want to see if they they have the appetite for investing with you guys actually.
So the reason why I guess you probably couldn't find much stuff on the website is in our conception and initially our target was to target ultra high net worth individuals, family offices, and corporate entities themselves, which is where we've raised the equity from the deal I was talking about earlier.
Okay.
But so that was our initial strategy. But again, because of COVID, and as I've mentioned before, the types of deals that we're getting offered now weren't on the market previously, and they're of a much smaller scale. So, for example, the deal I was talking about earlier, the equity raised is £9.75 million, which is I think about 200 million rand, with then development costs on top of that of about 20 million. So it's a really huge project. And that's the type of thing that worked when we initially started. But now there are a number of market opportunities that we're getting, which can provide some of the most phenomenal returns I've ever seen. Like 35% annualized returns over a 2 to 3 year period in pounds. And that type of deal was previously way below the radar of what we'd ever look at, because what we were trying to do before was we were trying to get into a nice niche of the market where we didn't have too much competition, where we're looking at stuff that's a bit too small for those big institutional funds that I was talking about before, like your pension funds and so on, but a bit too big for some of the smaller developers. And what's quite nice is some of the smaller developers have been releasing stuff to the market now again, because they're overgeared and now they're having defaults and some tenants. They need to raise capital to service some of that debt. And so now we're looking at stuff that we previously wouldn't have done, but the returns are just so good. It's just a wasted opportunity not to take advantage of those stuff, especially if it's such a temporary occurrence in the market. So that's why you probably can't find so much of that information. But the best way to get in contact with us is to basically email one of us. Our email addresses are on the website. I think we're going to be the problem we have as well with publishing some of the deals that we're trying to raise equity for online is that they're off market, so we can't actually take them openly. You see. Because otherwise the vendor will kind of come back and say, "What are you doing?" Now everyone knows that I'm trying to sell this. But
I definitely agree.
but the best way is to get in touch with us via the email. So myself, Sam, one of my colleagues, Hendrik, we're two of the best people to get in contact with regards to that. And John is on the ground in the UK. So if you go, I think it's on the context section, there are emails there. And then what we can do is on an individual basis, we can basically discuss with people the projects that we're working on. And then we can share some information, obviously on much more of an exclusive hush-hush basis between interested parties. And then we can kind of discuss the types of equity provision that people want to put in. And then we can also kind of put people in line with some of the projects that works with.
100%. So one more question, and then we're opening up the Q&A for everybody. This is a question I always ask all my guests, is if Sam had a superpower, what would it be?
So I feel like I don't want to answer too quickly, because it seems like I've obviously thought about this too much over my lifetime. I think it would be the power of persuasion.
Oh, really?
If I could persuade anyone to do anything, I don't necessarily really think I'd need anything hectic like being able to fly or being invisible. I could literally convince anyone to do what I wanted to do whenever I wanted to do. So I can convince everyone on this to invest all their money now.
And then they just press a button like click, 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 click. And then now all the money comes. Now that'll be interesting one though. But I think even if you had that one, you'll get tired at some point of it. You'll be like, you know what, I'm tired of being able to persuade everybody. You want to try something else where somebody can actually say no to you. You'll be surprised. But anyway, it's actually an interesting one. Otherwise, we're opening up for the Q&A, guys. Get in touch with Sam I just sent you guys the website here. And as well, if you have any questions that you want to ask, please just send us the questions. and then let us answer those questions for you guys. Otherwise, while we are waiting for the questions, Sam, do you have anything else you want to leave us with today? Yeah, I think there's a closing remark and things like that.
Yeah, no, I think so. I think to summarize, I mean, I know perhaps people might have some more specific questions about what we do in investing, but I think the way that I like to market myself and us as an entity is I don't really want to give people a drink from the fire hose and be here trying to sell you specifically, a product. I wanted to just open up the conversation and just kind of make people aware of the different types of investment opportunities that are out there. I think some of those more hands-on offerings are absolutely fantastic, but if that's not for you, there is more of an option than just necessarily investing into a REIT. There's other stuff out there that could work for you. And, it's kind of passive income. You don't really need to do too much work or too much stressing over it. So I just kind of wanted to open up that conversation today. And I think, one question that might be in the back of people's minds is, well, why you versus other people? I think with us is that we're well connected in the UK market. We have, a lot of track record and market experience there. And as a consequence, we get things like these off-market offerings and that type of thing. And so for us, it's very much the fact that we're not going in with our eyes closed. And again, obviously I can't say names, but unfortunately, I think with very good intentions, a lot of South Africans go into the UK market and end up getting burned for things. I think brokers and agents and things on the UK side see them coming, with an amount of cash, maybe deep pockets, a big balance sheet, and they lick their lips and they know that it's a good opportunity to get someone to overpay. And I think as well, because we're a small, tight-knit group, where our management fees and everything on what we do are incredibly low, and compared to some of our competition as well. And but the other thing is we're very much accountable for it. It's very direct. We are our team on the ground. We've got incredibly well trusted service providers and professionals who do our valuations, and our engineers and so on. But ultimately, the emails on the website is us. If you have any questions or issues, you're not going to get lost in some sort of corporate entity. You can email us and call us directly, and we're always kind of there, accessed to help.
100%. So I think that that's one of the questions I always wanted to ask you as well. I also wanted to ask you, but I think we skipped it, to say what are some of the mistakes people do to bend their fingers. But I think you touched on that already, to have some people who are well informed on the ground, and obviously do a little bit of your homework there before. Because the agents, as you say, they just see where you're coming from, South Africa. Okay, now the property is no longer like €9. Now it's like something else that's a little bit more ridiculous. So okay, we have a question from Vincent. He's saying, does your company also manage the properties offshore in terms of rental payments? That's a good question.
Yeah, so actually that also ties up quite nicely with what we were just discussing now. So what we also like to do is we like to push things onto trusted third parties, and these, as I say, because of especially John's track record and experience in the UK market, these people are people that we've already worked with and trust in the past. So we've already had experience with them, whether through Brightsky Capital or not. And I think the nice thing with that is that investors know that there's a level of impartiality. It's not all kind of in-house and us doing it. They're able to give an impartial third-party opinion on stuff, which you can trust. But also similarly, if they're not performing, we can get rid of them and we can use another service provider, that can perform much better or much more efficiently. So in terms of managing the properties offshore, then yes, So we've teamed up with a local brokerage and agency that has they have property management side of things. So effectively how it works with us is that you won't obviously be acquiring a unit per se, but you'll be acquiring equity in the business that owns that specific property. So that specific property will be fully rentalized over the investment term, whether that's, for example, 7 to 10 years. But our third-party property manager will do that on behalf of the investors, and they'll run the building and do everything that's required. And I think what's also quite nice about that is the opportunity of scale. So, for example, if you bought 1 or 2 apartments yourself, the management costs and the management fees on that would, in proportion to your rental revenues, be significantly higher. Whereas if, for example, we're taking 130 apartments to a property manager, say, well, this is a big ticket item for you. This is certain income for you for 7 to 10 years because you can manage this property for us. What's the best that you can do? So in summary, answering that question, everything's managed offshore. You don't have to worry about any of that stuff. And in terms of the value of the services provided by the property managers, you'll get very, very good returns. I think actually on that project I was talking about earlier, the annual revenue is about £4 million, and I think the property manager is charging £50,000 a year. So it's cheap when you have the scale.
Definitely. And I wanted to say that for you guys, we also in the SA for like our development projects actually, but we do a lot of greenfield. We don't do brownfield like you guys buying a flat and converting it and things like that. There are guys who are playing into that, but we're more focusing on greenfield. If you buy something, crush it down, start from scratch, it takes around 2 to 3 years to work on projects like that. We were also focused on all the ultra, net worth people, ultra high net worth people. And then we got to a point now where we have to let in other people as well. So what I'm asking is relative to if somebody or you and your team were focusing on only ultra high net worth people and all the corporate companies, if somebody has to invest, I don't think you're going to go to the minimum amount somebody can invest. What's the minimum amount can somebody look at? Or have you guys discussed that? Or is it something that you're still going to be, obviously they have to get in touch with you. Is it something that you can disclose with us here? In terms of the minimum somebody has to invest if they want to invest in one of the projects that you guys are working on?
So it really depends. So for example, on that very large deal that I keep referring to, we just had one investor. So from that perspective, it's a lot easier because of the actual fund management and back office stuff. If you have one person that you need to deal with and file reports and so on, it's much easier. True. But I think at the same time, as well, we're not going to turn away investors. I think it's always good to talk to people because, as I say, the equity requirement on that project was just under £10 million. But as I mentioned before, as well, we're seeing all these opportunities that were never really within our radar, but the return potential on them is absolutely phenomenal. So, some of that stuff is much, much smaller. So some of that stuff, the equity requirement overall is about £600,000. So I think we don't. It depends on a project to project basis because, as I said, we set up a separate SPV for each development or each project. So depending on which project it is, I think the equity requirements would vary. So I think it sounds almost like a bit of a cop-out answer, like I'm avoiding the point. But it depends on a project to project basis. So I guess the best thing is to actually just get in touch with us and then discuss what kind of equity you're looking at investing. And then we can basically point you in the right direction of the types of things that you might be interested. Because the other thing is, as well, is it might depend on what kind of returns, someone's looking for. On that project, the larger one, annualized returns about 18.5%. But on some of the smaller ones, they're around 25 to up to 35%. So it depends, does someone want Does someone want to invest and get, 25, 35%, but over 3 years? Or do they actually just want to let their money sit there and get 18.5% return for 10 years? It depends on what their own goals or own achievements are, or their own tax situation, that type of thing. So yeah, it's quite subjective, I guess, if that answers the question by not really answering the question.
No, so you're saying it's going to differ from investor to investor. Everybody else is going to have a different situation. That's what you say.
Yeah, exactly. So yeah, so it depends on a project basis of what the actual investor wants to put in, I guess.
All right, 100%. So we not getting any more questions. So this is where we're going to be ending our session. I think we did like 1 hour straight. This is the first time we just went like straight to an hour. We usually go a little bit like extra. Otherwise, guys, get in touch with Sam. Check out all our replays on the YouTube channel as well. If you're not subscribed to the YouTube channel, I think you must do that so you can see all the other material that we release there. There's a lot of other weekly YouTube videos that I drop there. My team and I try to work on very, very value-adding videos that we drop there, as well as trainings that we do on a weekly basis that you guys can check out. So go to the YouTube channel and check that out. Get the ebook, get the course, as well as the training that we have online. I think I encourage you guys to join us. The people who are joining us already, I'm sure they are seeing the results. And I think that this is where we're going to be ending our session for today. And we will see you guys next week, same time, same place. Actually, a little bit on time. This week, Sam tried to push it for 1 p.m. But next week, we're going to be back at 12 p.m. And thank you, Sam, for joining us as well. We appreciate you joining us here today. And I'm sure that everybody who attended learned something new and they gain as much value as possible. Otherwise, Asika, I would say thank you. 100% thank you as well for attending. We appreciate you guys taking the time and attending the sessions. And we'll see you guys next week.